Good day, fellow investors. So over the last years, one of the biggest complaints in the comment section was that there is nothing cheap. Well, today, with oil stocks that are at multi-decade lows, if you want cheap and if you want value, look no further. If we look at oil stocks, Royal Dutch Shell, the stock is now at a lower point than in 1994. This is 25 years, and you cannot call this a bargain. If we look at the market capitalization is almost $100 billion, and if I take a look at their 2018 projections, they estimated to have 25 to 30 billion in free cash flows by 2020. That's a return of 25 to 30%. 25 to 30%. Talking about cheap. Suncor Energy also there where it was in 2003, so what is that, 17 years, the dividend yield is 5%, and they say that if oil stays at 40, they will maintain the dividend. Another dividend player that is all about the dividend, its holy grail is the dividend. The stock is at 20-year lows and the dividend yield is at 10%. What do you want cheaper than this? Total, another company, same pattern, and the important thing is we have seen OPEC-Russia war, stocks started to decline, all stocks, then the COVID crash, then a big rebound that's 50% up, and now all follow the same pattern here down, but all are at really decade lows with high dividend yields. All except Saudi Aramco, but that's low float, different market, different money. Probably they are engineering the price because it doesn't follow, but you also can't buy that. Different story. And here we are. If you want to make it in investing, if you want to make a lot of money, Buffett says be greedy when others are fearful and be fearful when others are greedy. We are in an environment where others are totally fearful. So as all stocks move with the same patterns, we have to see, okay, how to approach these things? Is this an opportunity? There will be some opportunities, there must be some opportunities, but in order to be greedy when others are fearful, we must know what we are doing. And that's exactly what we're going to discuss in this video, give you the key points and fundamentals of investing in oil stocks, which will help you with your fundamental decision, the decision that you will make, and see whether now a bet on oil fits your investment strategy or portfolio. Someone must be wrong. It's either the market or oil companies. Let's discuss. What are the main issues? So, price of oil long term, will it be 40, 50, 60 or 30? Is the bad news priced in? All answers that we're going to elaborate on in this video. Will there be dividend cuts ahead? Dividend cut is never priced into a stock. It always hurts when it happens. CapEx investments down. Will this lead to lower supply over time that will later lead to higher oil prices? Or is it a structural issue for oil? Headwinds, electric cars, Tesla. Is it OPEC against Russia issue, a war there, lower prices? Do they want to eliminate shale US producers, and will they stick to their production levels? What is the real value of a stock? Low risk, medium reward, or high risk, high reward? What are you looking for? These are the answers. Here you will get the answers. So let's start by discussing what's going on. There is negative sentiment. Barron's says lower oil price for longer, which brings fear, and then also the Church of England, I don't know if they have any connections inside or upside information that they use, but they have sold all their Exxon stock, so very big pressure, oversold likely because such big drops are not really rational, and those drops are equal with all stocks. It's just that ETF, index fund trading, let's sell all, let's throw out the baby with the bathwater. Just to look at the core holdings of the Church of England, second position is Royal Dutch Shell. So they sold Exxon, but still 2019. We'll see in the next report. It was just something funny to look at. Then, when it comes to oil price analysis forecasts, let me tell you something. Those will always be wrong. In 2008, Goldman analysts projected 200 oil on a super spike. Then a few months later, 6 months later, the same analyst said, oh, it will be 45. So it's very difficult to project what will happen. Depends on so many factors, but we have to focus on the fundamentals. And the best projection that I have found about where will oil prices go is that nobody knows. So we have to focus on the fundamentals. Will OPEC decide to go to war or not? Geopolitical issues. Will Venezuela reach its previous production? When it will happen? So long-term structural demand, electric cars, COVID impact. Will there be a second wave? More lockdowns that will lower demand, increase inventories? So how long will that last? And all of those things impact oil prices, which are unpredictable. We don't know what will happen, as we didn't know that this will happen a few months ago, or 8 months ago, to be more specific, 10 months ago. We are now into this. So that's something impossible to predict. And as investors, we have to focus on what is possible. And those are the fundamentals, and this is the fundamental of value investing, which is all what this channel is about. So if you like that, please subscribe, click a like to this video, it means a lot, and stay tuned. I have found a Federal Reserve research that asked 160 executives in the oil industry in the US about going forward in the price of oil, and 74% of executives said that they believe OPEC will play a bigger role in the determination of the price of oil going forward. So investing in oil is being under the mercy of OPEC. There is no way to avoid it, and that's something we have to be careful about. Also, I mentioned Venezuela production fell, but this is a few percentage points of global supply at a lower cost that can again impact oil prices, lead to many more crises. So the first message, the first key pillar of investing in oil stocks, it's impossible to predict the price, so we have to focus on the fundamentals, and that's what we're going to do now. If I look at the fundamentals, the major players, especially Western ones, are still projecting oil at 60. This is from the recent presentation from Royal Dutch Shell. So 2023, they see oil prices at 60, 2022 50, 14 2021, and 35 the average for 2020. This is their projections. This is what they base their living on. And now we have to see whether they are right or wrong. However, refining margins have been revised downwards by 30%, so midstream and downstream. Very, very interesting. But this is the determinant of investment returns, both for Shell and both for you if you decide to invest. Also, something that we can discuss whether it will be right, this is from Exxon. They see that in the next quarter, demand for diesel and gasoline will be equal to prior years. So they see COVID impact over and that the world will return to normal. And this is also something questionable. Why should it return to normal when we have now much more stay-at-home work, much less traveling? So even if it's just, and that's very important to understand when it comes to oil, even if it is just a few percentage points, you'll see later in the cost curve, those few percentage points in change in demand or supply have a big impact on oil prices and your returns. And then most oil companies base their outlook on global growth, middle class growth, higher energy demand that according to them will increase demand, and they have to supply the oil for it. So double in middle class over 15 years to nearly 6 billion people from the current, what is 4.5 billion, more cars, more demand for oil, and this is their projection that oil demand 2010, 20, 2030 will be a little bit higher over the next 2 decades. Natural gas, which I'm more bullish on, much higher than now, so growth there, but oil stable, coal also their projection is stable. However, if policies change, then we have a big decline in oil, and this is nice of Exxon to simply say it, and this could be very detrimental for oil stocks, oil supply and demand, oil returns, dividends. This is a big headwind. So we don't know again which of these two scenarios will prevail. This one, the positive one for oil, even more positive for natural gas, or this one when natural gas stays stable and oil significantly declines. But here is what they show, that outlook for natural gas, you see much more growth, much more positive growth, that without investment, but they are investing, they have just lowered a little bit their investment, so it depends on how much they invest, at what prices it's payable, it's feasible to invest, and that is the outlook for demand and supply for oil. However, now with low oil prices, the count of US rigs has declined, what is this, 70%. The current number is 266, a year ago was 589 rigs higher. This means less production, less in the future because of low oil prices. Less production leads to higher prices when demand increases. And here you see again the Fed research. So in order to bring back the number of rigs in the US to operate, to make it profitable, you at least need oil with 50, 55, and then also even 60. At lower oil prices, it's not profitable to bring back those rigs, which leads to lower supply. Lower oil prices mean lower number of rigs, lower investments, and here, this is from Bernstein, you see how CapEx spending is likely to continue to decline due to lower oil prices. And then lower oil prices, less supply. If there is a jump in demand, then CapEx will continue to rise. And everybody is projecting 60 oil, but this is the current situation due to COVID. Oil demand has really declined 10% in the worst case scenario, but is still down, and we'll see how it impacts. Inventories have jumped, which creates a glut. Everyone wants to get rid of that oil and lower prices. And then if we look again from Bernstein, the supply and demand, they expect, which is what oil companies use, a normalization and then lower supply than demand already in the first quarter of 2021. Also same fourth quarter of 2020. With what's going on in Europe, this is unlikely to be hit, but this is what they base their projections. It's not happening, and this is perhaps the reason why you are seeing all those cheap oil stocks. But sooner or later it will happen, and then the question is, will it go back to the previous levels, or how fast it will go back, and what will be oil prices? This is my concern. This is very important. This is from Europe, but should be similar globally. Road transport takes 47% of oil demand. Then we have shipping. Recently, Rio Tinto said they will switch to natural gas from the bunker fuel they use, and aviation 9%, 8% globally. So road transport is key, and we have to see, okay, what will be the long-term structural trends there for oil. Electric vehicles, this is again from Europe, but similar, applicable to the globe. The current projections are not that positive, just 10% of new sales in 2025, 30% in 2030, but over the long term, 2040, and this is what you base your decisions, long-term decisions when you invest in new oil projects, it's 100% in 2040 already. So oil in 2040 is done. That's it. And that's something we have to keep in mind, which means that oil over the short term, it becomes a short-term investment and playing with the supply and demand. That's key to understand, because demand is about to go down. This can happen sooner or later, but this is the trend they are in. And perhaps even more important, I just want to compare the 2010 Mercedes E-Class consumption with the 2020. This is 21% less. So this is even more important than the electric cars. New cars consume less, and therefore even lower the demand for oil. So if this is not back to equal, but let's say 10%, 5% due to stay at home, due to who knows what, that will be a big hit for oil, and oil prices will recover later. So these outlooks going back to normal already in 2021, and then the price at 60, and here you see also the price projections are also at 40, and this is what Russian producers always take into account. They never speak of 60 like Western producers, they always speak of 40. So a different perspective there, different focus, different exuberance. Good to keep in mind. Then future, the outlook again. The outlook is unknown. If we look at the marginal cost of supply, it was at 100, then shale oil boomed, etc., sustainability, and now we are already down at 60. What if it goes down at 40? Then companies like Exxon, Shell don't make that much money anymore, and that's likely what the market is pricing in now. But as we said, there are many companies, different companies there. So this is something very important to understand. The trend has been clear in the 2000s, but now the trend is also there and pretty clear. What to expect here? Well, high volatility, because that's the cyclicality of the environment. When oil prices are high, all those rigs come in to work in the United States, supply goes up, prices go down, especially if there is a recession or something like that. That's the oil environment, and therefore you should expect volatility, especially low barrier to entry. And volatility means we as value investors have to take advantage of that, because the market is irrational. You see how it reacts irrationally on things, because it's always an overreaction. If you base yourself on low risk fundamentals, you can make good returns. So if you find producers that have production cost, total cost of 30, you know that they will make little money now, but more money when it goes up, but the downside is limited. That's value investing focused on risk. If you want more, then you can bet on higher cost producers, and then you have to have a right strategy. What do I do if it goes lower? Timing, but something to think about depending on the oil company that you pick to do so. Again, from a value investing perspective, my thinking is, okay, it's interesting to start a strategy now, buy oil stocks, and then sell them later at 50 when oil is at 60, because I'm sure it will be volatile. That's not hold forever, but the trends for oil are negative, which means it's not a buy and hold forever situation anymore. But the pension funds don't know that yet. Also, what's wrong with Shell's prediction is, I think, this is again from Shell from earlier, they predicted $65, but 2015, 16, 17, 18 and 19, just in 2018 for half of the year it was above 60, then it crashed, and just 2 times in 2019 oil prices went above 60. So their predictions are a little bit too exuberant. And this is perhaps the key chart here, the cost curve. If we look at the 2030 break-even capacity cost curve, and look at the price. The marginal producer sets the price, but if these are just what, 5 billion barrels a day, 5 million or billion barrels a day. This is 5% of production. If demand is lower, then we are already at the maximum price of 60. If we lower a little bit, a few billion barrels per day, then we are already at 50, which makes it very tricky. So if you want to invest, then it's interesting to look at those companies where the average costs of production are below the competitors. This is value investing. This is speculating. I think you can make money on speculating over the next year, 2, 3 years, but be careful with your strategy. If demand declines, then we are already at much lower average long-term prices, which means not good for companies like Shell, Exxon. They need 60 for their mental projections, for their cash flows. If it's not 60, if it's 40, then expect a lot of volatility. And the long term is certain. In 30 years, production will be much lower and oil is slowly exiting this world. So see how will you approach this. Check how much oil reserves the company has, at what cost it can be produced, total cost with the investments. Wells dry up, you need to invest a lot more to pump more, etc., etc. And then see the fundamentals, where is it placed on that cost curve, because if it's higher, when oil price higher, then you can make a speculative return. If you want sound value investing fundamentals, buy the low cost producers, and then okay, the upside will not be that big, but it will be. And the downside, well, at these levels, given that oil would likely be at 40 to 60, perhaps sometimes down to 30, the downside is minimal. If you want to check what I do, my bets on natural gas stocks, which have a much positive outlook in the long term, which lowers my long-term risk, please check my stock market research platform. If you fancy a good read, please check my book. Thank you for watching, subscribe. Next video we'll discuss more in detail Royal Dutch Shell, perhaps Suncor. So I'll see you in the next video on Sunday. Don't forget to subscribe and click that notification bell. Thank you for watching.